Hi, and welcome to Random Rogers Big Picture for the week of August 12th. Well, this week was a little worse. Thursday, as you know, was a pretty bad day, especially around 12:30. I actually did get pretty rattled. No, not the stock market again. The Nussbaum family came up to Walker for a visit, and the skies darkened, weather patterns changed. They blew in, and they blew out, and calm was restored. And I've got nothing going on this week, so that'll be the last of that kind of psych-out bit if the market takes another dump next week. Three things on the agenda. One is something about long-term context. One, a very specific question about how much cash and double short I have from a reader. And then one last little kind of, commentary thing about kind of what I'm trying to do, the stuff that I've written about over the last few months, kind of how that weaves into what's going on right now. So first, long-term context, and this is important, very important to understand, which is if you take all of your stock market money, whatever portion of your pie that is, and you put it in stocks, regardless of what exposure you capture, or how you capture the exposure, and you save properly, okay, really, you don't need to make any changes. You don't, realistically need to sell or buy as a function of what the market is doing. As a function of getting older and maybe reducing the allocation, that is something completely different. But in terms of market volatility, if you're saving properly, you don't ever need to make changes. We'll not worry about the notion of rebalancing. This is really a kind of a 60,000-foot issue. And from top down, the most important thing is to own stocks or to not own stocks. Over time, stocks go up. If you bought the day before the 1987 crash, 10 years later, you were dramatically higher. 5 years later, you were higher by quite a bit. If you bought in 2000, or right at the peak at 2000, the S&P 500, you're break even despite all the bad things that have happened. 10 years ago, if you bought, you're up at something like 80%. I think I figured it. It's something like that. Point being that managing time horizon correctly, all of this stuff that we write about, all of the comments that are left, everything else, you don't actually need to do any trading. If you've got the right time horizon and the right mix, and you change the mix when it's appropriate, regardless of what the market is doing, and you save properly, you're going to have enough money, assuming you're not someone who spends beyond their means. That's a very important building block to the whole conversation, or to the whole topic of investing. So the reason why that's important is, a lot of people get caught up in making a lot of changes, more than they need to, when in the backdrop is always this notion of, really, if they just save properly and have the right mix, over time, they're going to do what they need to do. They don't need to worry, get emotional. They don't need to open a statement for 20 years. That's hyperbole, but you get what I'm saying. That's an important building block to managing your own portfolio. From that standpoint, then, moving on, and maybe I should have had this second in the upfront agenda, what I try and do in client accounts, the things that I write about and try to explore on the blog, are about how to smooth out the ride a little bit. That's it. Smooth out the ride. At different times, it makes sense to, and this is something I said during the week, to have more exposure to volatility, and sometimes it makes exposure to have less exposure to volatility. The reasons I cited in the blog during the week: end of cycle, probably a good time to be underweight volatility. There's no analysis there. You can, come up with that on your own. That's pretty easy stuff. And so that's something I've written about. The few trades that I've made this year, selling China in January or February, whenever I did, I think it was February, reduced emerging market, that reduced volatility. Emerging markets hit them very well, all good stuff, took it back to an equal weight. The emerging market stuff, I'm sorry, I misspoke, the material stuff, that whole commodity boom, I love that sector. Yet I have never gone hog wild in it. I always advocate moderation, but emerging markets, commodity, I love it. They have no idea how much I love it. Okay, that's the end of the Kramer bit. But it's the truth. These are great themes that over your lifetime are going to make you a ton of money, but at different times the weighting needs to be changed. If you're interested in smoothing out the volatility, which, since I get paid to do this, yes, I'm interested in trying to do that. Same thing with financials. I've had pretty much the same weighting in financials for like 2.5 years, which is very underweight domestic. And I've been writing about it on the blog. If you actually spend the time looking through the archives, which are a little easier to search now, you'll see I've had the same underweighting, just kind of expecting that there were excesses that were going to create volatility. Now, by saying I've had this positioning for 2.5 years, tells you I was early, tells you I did, I didn't time it well at all. But the more important thing is that client accounts weren't compromised by that, because I had some good exposure in some other places. Again, all stuff I've been writing about throughout the blog. A lot of this stuff that's happening now has all happened before. This is stuff that I've written about well in advance of it happening. I've positioned the portfolio well in advance of it happening to do exactly what I tell clients I'm going to try to do, emphasize the word try, which is smooth out the ride when it gets bumpy. And knock on wood, that's what we've done so far, and I've disclosed how I've done that in the blog all year long, and really throughout the entire life of the blog. That's important. It's been the same theme all along, and it'll be the same theme going forward. At some point when the curve normalizes, it will make more sense to go back into financial, or heavier in financials, have a little more exposure to domestic financials. I don't know when that's going to be, but it seems like, since we haven't even had a recession yet, that this economic cycle is going to end at some point, and only in the middle of a recession does it make sense to start thinking about adding in. So that's that. One last thing specifically about how much cash and how much double short. The reason why I didn't answer this on the blog, don't want to lose anything in the translation here. This is kind of difficult because each account, depending on when they came on board, we had quite a few clients come from when I first added the double short a year ago. And it depends on the client. So I can only talk very generically, extremely generically, about 15% cash and about 2.5% allocated to the double short. Extremely generic, both numbers, generic, generic, generic. 2.5% in double short means the hedge is about 5% of the portfolio. The 15% in cash means that I could neutralize another 30% if I needed to. I'm hoping I don't need to. I'm ready to and willing to if it looks like it's going to go that way. And I may get faked out one way or the other. I don't know. But that means that I may not need to do a whole lot of selling. I'm really not in a hurry to sell stocks where fundamentally nothing has changed, or I perceive that fundamentally nothing has changed. But there's no way to be 100% right all the time. All I can do is, bigger picture goal is try to smooth out the volatility. Some of the tactical ways to make that happen will work and some won't. Hopefully they work more often than not. Have a great weekend.